Okay, we'll start. Before we get into charts and stuff, charts are just for examples. We'll check through the theory of what technical analysis actually is. There are basically two types of internal indicators. The indicators that are on charts, basically based on price and whatnot. So those are trend following and trend sensitive. Trend following is like moving averages, and trend sensitive is like RSI, basically all momentum indicators. So momentum itself, ROC, rate of change, all of them are trend sensitive. You can actually go through that. It's fairly straightforward what trend following and trend sensitive are. Usually we can also use it as stop loss, which is what I use it as, and trend sensitive can be used for mean reversion. But yeah, the problem with trend following is that using moving averages is that there are a lot of false signals if you have it too sensitive. So if you have moving average of very small period, let's say 9 or 10, you'll have a lot of price crossovers or different moving average crossovers. If you have moving averages of, let's say, 20 or 50 or something, you'll have fewer of them, but those the signals will come more later. They'll be more delayed. So it's possible to give up some of the gains. That's one of the, you have to balance between either be more sensitive or be more true. The signals have to be more genuine, not the false signals. And in a similar matter with trend sensitive, if you have too sensitive of an indicator, let's say RSI, it'll oscillate far too quickly. It'll be tough to make anything out of it. And if you make the period way too high, it'll be tough to basically have many mean reversion strategies, and the signals will be too few to have a proper backtesting strategies. Second concept that we'll go through is systems. There are two kinds of feedback systems: negative and positive. Negative feedback is basically mean reversion, arbitrage, that kind of stuff. If Nifty goes way too high above its moving average, there'll be some or other constraints which will get it back to moving average and vice versa. So all the bottom fishers, value investors and stuff, they'll buy Nifty or whichever stock from way in the bottom and move the price back to mean, that is moving average. And mean reversion strategies, they help and they provide negative feedback in the market also. And positive are exactly opposite. They amplify a system's behavior. So you can think of bubble, you can think of what happened to Z Limited, anything. So there was a news flow which was fairly positive, and because of that, many people, many investors, investor decisions, they imitated one of the prominent investors that we know, and instead of their own independent choice of going through Z businesses, well, assets and whatnot, instead they followed the prominent investor and they amplified the behavior of price. Usually, momentum investing, breakout investing, that kind of trading, or trend following strategies, they are more effective when positive feedback is the one dominating rather than negative. And the absolute basic beliefs of technical analysis is the market's trend. There is either positive or neutral or negative direction to the market. Direction. It doesn't have to be a straight line. It just has to be direction. And yeah, it's when you get down to it, it's all supply and demand. It could be based on interest rates that RBI has either raised or decreased. It could be anything. But if there's a lot of supply, the prices will have to, it's just based on demand and supply, demand divided by supply. In a similar fashion, the price discounts a lot of things. This is especially true in indices, in Nifty and Nifty 500. It discounts, it basically, I wouldn't say forecast, the sentiment is brought into the news, and the reaction of the investors, emotions and whatnot, sentiments are brought into the price action, which is one of the reasons the sentiment is one of the reasons it's tough to quantify price action. If the market sentiment is too euphoric, Corona's second wave wouldn't have much of a problem. We'll get to that later. In a similar fashion, we'll see that if the market is way too bearish, even small positive news, which would actually be good for a country or for the particular industry, would be quote unquote discounted and the price wouldn't rise too much. And yes, prices are not random. There might be noise might be random, but as whole price action is not random, it trends. And finally, prices and patterns, trends and patterns, sorry, are fractal. So what I mean by that is the patterns that you see in hourly charts or 5 minute chart can be replicated in monthly charts and weekly charts. So whatever you study from energizers, videos, and whatnot, all that can be applied in my sessions. That is weekly and monthly charts for long term. We'll revisit Dowd-Ferry real quickly. So the primary trend, according to Dowd-Ferry, is invalid. You can't manipulate the primary trend. You can manipulate the short-term trend and even the intraday trend, intermediate trend, but it's very difficult to. It's not possible to manipulate the primary trend. If the economy is doing very well, the market must go up, and vice versa. Same with companies. If the company is doing very well, the market should go up. The price action of the market of the company should go up. Indices, as we said earlier, they discount basically everything, and they discount the emotions. That's the bigger part, I think, than the news flow, as we see in last 2 years. And stock markets, the indices must confirm each other. So, according to Dow, back then there were railroads and industrials. He took an example that if industrials are producing but railroads are not able to transport, we'll have stagnation in economy. So, in a similar fashion, over here, we have got many indices like Bank Nifty and Pharma, which must confirm if banks are not providing proper capital, if they are not doing very well, the economy itself, as per RBI, might have stagnation or might suffer. And trends are confirmed by volume. This is especially true in breakouts and trend following people. They look for volume in trend, especially when the trend starts. If the trend starts with an opening gap on volume, it's a very big sign that the the primary trend is going to persist for a very long time, for years to come. And yes, and trends persist. Generally, primary trend is for like 6 years, 3 to 6 years, and secondary trend is for just few months. Generally, they persist, and the best way to get profit out of it is to just buy and hold for the whole primary trend, according to Dow, Charles Dow. And yeah, we'll get to this later. So now that we have got some theory behind us, at least, we'll go through some of them. One of the basic things that we have to see in technical analysis is price action. And sometimes when we are, especially us intraday traders, sometimes when we are in 5 minutes or 15 minutes charts, it becomes easy to miss out on a big picture. So, like let's say over here, I see a downtrend, and suddenly I'm bearish on the Indian economy as a whole. The problem with that is when I go in the bigger time frame, the larger time frame, that is 1 day or 1 week, I'll see that I'm fairly not very correct because we are still in a like raging bull market over here. There are still higher highs and lower lows, and but yeah, basically by missing the forest for trees, I'm having worse decisions, worse investment decisions. So whenever in doubt, always go back one time frame. You can go back, let's say 1 month, 1 week, 1 month, or yeah, etc. By going back by 1 month or 1 week, it becomes more simpler to just see the trend. So, as I said earlier, trend is a direction rather than line. So ignore the moving average for now. The direction of market over here, for example, is sideways. It's a sideways moving trend. As a long only investor, it will be tough to make a lot of money of the sideways market. So what you want to do is you want to capture as much of this as possible. So from Dow Trade, we need higher highs and lower lows, higher lows. Sorry. As soon as this is broken over here and we see a lower low, as per Dow Trade, we should be in the market until the trend persists, which is somewhere here when the swing low is broken. This low here, and the one of the problems with this is that the criticism of Dow Trade is that it's kind of late. We have already given some 20-30% of our all-time high, 40 almost 40% of our all-time high. So for that we use indicators, we use different studies with that complements Dow theory. This is one of the reasons that we use moving averages. Moving averages are trend following by nature. So let's say, since it's a monthly thing, let's say it's a yearly moving average, so 1 year. Instead of getting out over here and giving up 40% of him, we have improved our strategy by taking up all the primary and giving up just this much, just 2 months of returns. So this way we can use technical analysis in complementary to Dow theory and to other fundamental ways, the way the economy is going, etc., to stay in primary trend and capture the big picture out of it. Even here, when it breaks out and very well, as per Dow theory, this is when we should get in. As per moving averages, this is where we should get in, somewhere here. We also talked about demand and supply. One of the ways we use demand and supply is using market sentiment, the emotions of the market participants, and that can be seen very well in candlestick patterns. So let's say you're looking for candlestick patterns. By the way, just go through this book. For this book is really nice for candlestick patterns thing. Yeah. With that out of the way, this is one of the more recent ones. Now you might say it's hindsight bias and whatnot, but there are more ways to confirm that it's a- at least in intermediate term, it's a top of the market top. So this one is an inverted hammer. It shows with the longer upper shadow. It basically shows that the bears are taking over. Bulls could not push it towards the end of the month. That is, so around 19th October. If you go in daily charts, you'll see the bears are starting to push over, and with mean reversion coming any second now, you can kind of see it coming. It's been a while since we had a mean reversion. Of course, we can't count this under December candle because there's still a few days remaining. If it actually is, it's a doji, which is equilibrium, which is like confused state of the market. But for now, we'll focus on this candle over here because this shows crucial information about the market psychology. When we see larger candles over here with longer lower shadows, we see there's a hidden bullish pressure over here, buying pressures. People are buying a lot over here. It forms a good support. In a similar fashion, if we see longer and longer uh, wicks, longer shadows, we see selling pressure. And this one over here usually happens in market top. If it happens somewhere in the middle, it's ignored. So see this, for example, it's supposed to be market bottom, but it happened in middle, so it's ignored. That's something that you have to look at, as I said, candlesticks of course. But anyway, so using this, you have one of the earlier warnings of a market top, and the confirmation would of course come with a moving average. If it goes below moving average, like it went over here, That's the selling thing. And again, with moving average, you get to capture big amounts of primary trend. As a long-term investor, you want primary trend. Primary trend cannot be manipulated, as we learned in Dow theory. Indices, most indices, discount everything. Yeah, now we come to stock indices must confirm. So we see, yeah, it's true. It took about 8 months for Nifty to recover. It recovered around like October, I want to say November. It recovered in November, and this was probably the fastest bear market that I have studied, except the flash market in US. But in Nifty, it's probably the fastest one. But anyways, getting back to point, even this itself is a candlestick pattern if it's in the market bottom, but it's not, so we ignore it. It just the length of bear market just depends on market. Usually, as a technical analysis, we don't want to question the market. If the market says yes, the bear market or correction lasts just 3 months, we just want to go with it. Like in second wave, this is the second wave of coronavirus. April, March, yeah, April, March, and April and May. May was towards the end of the wave. So we just don't want to question it. We want to go with the flow as technical analysis, because we don't want to question why it's happening. We just want to know what's happening. So in this case, the second wave was just these two candles. It's basically nothing. It's, in fact, I would say it's healthy that in a raging bull market as this one, we have these two candles over here. And even I would argue that this also is healthy to have a few red candles over here, because extreme growth equals to a bubble kind of sorts. And as we say in positive, yeah, positive feedback systems, as more the problem with positive feedback systems is that they are not sustainable. They go higher and higher across like further from the mean, and the higher they go, the sharper they fall whenever the bubble or whatever bursts. That's the problem with positive feedback system. Negative feedback systems are balancing acts. At the same time, you don't want too many negative feedback systems, otherwise you'll end up like this over here. The market's going nowhere because there's a lot of mean reversions. Market's always towards the mean. So you want a balance of both of them. From time to time, you want negative feedback systems from arbitrations and mean reversions, so the market comes back to mean and has chance to get back up like this. Yeah. In a similar fashion, we'll see different stocks what it did. I know ITC is a meme, but since it's a fairly profitable company, we'll still take that example. Yeah. This is lifetime or whatever rating you has data of ITC. So for long time, it was in a bull market. We could say that its primary trend is high, is on the upside. With a small bear market, went again to bull market. So after some 6 years of correction, 2,700 days, we are still in a like sideways market with RLC. One of the uses of moving average is also to know at what the primary trend of the market is. Usually, people use 200 days or 250 days daily moving average. In my case, it's just 12-month moving average because we are in a monthly chart. So yeah, in spite of having very profitable balance sheet and like basically the company is really good, it has a really good margin in cigarettes, but that's all. So fundamentally, it's not so bad. It's not as bad as many people say. However, the price action is what the market is thinking of it, and this is true not just of ITC but of the whole tobacco companies in general. So let's take an example of other tobacco companies. I have taken about seven uh, tobacco companies from around the world, including Philip Morris, Japanese Tobacco Corporation, etc. And I have made a basic average out of it. So it's like Dow Jones kind of average. So all of them have their, yeah, it was just an example. So all of them, they started the bear market in 2016s and 17s. And you see, it doesn't matter which market the companies are trading. If even if it's one of the companies is Finnish, if it's Finnish, Japanese, or American companies, or even Malay company, hmm, even Malaysian company, the market responds in a similar fashion. All of the companies are in a downtrend, and after the COVID thing, they're in a moderately uptrend. They're still not out of the water yet. According to Dow theory, this thing would be the level that they want to cross, 2979. Yeah, but going back to Z Limited, yeah, so we talked about the amplifying effects of positive feedback in a system like this one. This is, of course, the most prominent example that I can give. That out of basically nowhere, we found Z Limited, which had gone 100 over 100% up in just 3 or 4 weeks. But the wicks you see, they are very long wicks. It means there's a selling pressure, and of course it's all weekly. There's a selling pressure of the negative feedback systems, the arbitrages, the people who want to book profits from this side over here. So that's basically what the positive feedback system does. It amplifies all the way from 171 to some 200, 300. And then of course negative feedback system comes and moves it back to the mean reversion. Now we'll take a company which is basically a survivorship bias. It's one of the IT companies which has survived a lot of things, and we know it's a good company altogether. So let's say you have TCS. Yeah, yeah. Let's say you have Tata Communications, sorry, Tata Consultancy Services, and let's say you are in this portion over here. You're halfway there. In monthly, we can see very easily that's in a clear sideways train. But in daily and even before daily, there are some intermediate trends and stuff. Here's intermediate trend one. There's under short term trend, and then again intermediate trend here, which makes us think as if the security is trending. So when in reality, if you see the monthly charts, whenever there's doubt of anything, just go back one time frame. If you are doubt of the daily charts, you don't know where the market is going. Let's say you are here, just go back weekly. So around 115, 16, just go back weekly, and you see what's happening with the stock. So yeah, if you go back weekly, you see the trend has reversed. It's in the even the moving average. It's sideways now. The moving average. If the moving average is sideways, you don't want to be in the security, which is in the moving average sideways, unless you are accumulating it. But for primary trend, this is how you want to go. Again, in monthly, in spite of this, we know that it's still an uptrend. It has not crossed this part over here. It's a really good support. That's how you jump between from one time frame to another, and make sure when you want to enter, you can enter in intraday time frames just to get a really good entry and exit price. But when you are having an idea basically, or you want to confirm your fundamental idea, you should look at monthly or weekly first, and then go for intraday or daily charts. And this is also similar to Asian Paints and HUL. HUL itself was in a downtrend, which in weekly charts you'll see all kinds of reversals here, and you'll think, okay, it's reversing, okay, reversing. When in reality, it reverses many years ago in 2004. And with moving averages, I'll just change the moving average thing. With moving averages, you can see, yeah, it's always in a downtrend except here, where there's a crossover and then it's an uptrend for a very long time. It's still an uptrend, with the exception of this, which is this image. You see, you get a really clear image of what the stock is doing, the structure of the stock. Now we'll get into trend sensitive. While moving averages and other trend following indicators, they are very useful for identifying what the primary trend is. 200-day moving average. Trend sensitive are useful to identify when to entry, when to exit, the intermediate and short term things. Even in this over here, you can see while the price action is going higher, moving average is going lower and lower. And that's a warning sign, the red flag itself. You'll see similar in Nifty. Whenever Nifty has its extremes of either overbought or oversold. Yeah, over here in the 2 weeks itself, there's a diversion. So there's one warning right here. You take many such warnings from trend sensitive indicators, from trend following indicators, from Dow Trade itself, the fundamentals, and you put them all together to make a picture to either buy, hold, sell, or, or either short. Even in shorting over here, you can see the RSI is tapering off. The problem with RSI, the problem with any trend sensitive indicator, is that for a lot of time, it's in neutral area. You can see over here. And if you want to make it more sensitive, there'll be a lot more oscillations. So, lot more oscillation mean lot more fake signals, or lot more earlier signals. Sometimes you don't want signals too early. You might miss out on some gains. So that's the balance that you have to strike. And same with moving averages. You don't want moving averages of, let's say, just two. That doesn't tell you much. Same with moving average of, let's say, 1,000 or something. You want some, at least some balance. So I personally, for my primary trend, I want to see a year's worth of data at least. So in weekly charts, I like to see 40 weeks, in daily 200 or 250, and in monthly about 10 or 12. And it also depends on the security itself, the asset. If we take an example of MCX, yeah. If you take an example of MCX, it doesn't, it hasn't done much over the many years. However, it still has primary trend and secondary trends over here with like minor bull market of few years. So that's where you want to is this is where you want to stay. Although in this case, because of lack of data, the moving average doesn't work very well. You probably have to go back to 1 week data. Yeah. In a similar fashion, using moving averages using Dow 30, we can basically skip the whole bear market over here. And although we kind of lose out from this thing, we still have a good chunk of returns left over here. And using something like RSI, yeah, using something like RSI, you can find out where the most the overbought and oversold the zones are. See over here, and stuff like that. Here's an example of the diversion. The prices are making lower lows, but RSI is making higher lows. This is like the first warning that yes, it's a real thing. This swing low is a real one. Second warning, of course, is the moving average. And with the throwback over here and retest, they basically confirm only to go back to its bear market. Yeah. You'll see similar story in SBI. In daily and 15-minute charts, it's tough to see this big picture where SBI for a very long time has been is hovering around its moving average. For a very long time. Unless you have captured these over here, which is after pandemic, it's tough to make much money on the primary trend of SBI. So yeah, this is basically how to use basic analysis on long term. Any questions?
Hi, just a small question, man.
Mhm.
Yeah, you're going with monthly and like monthly trend, right? And if we're touching 100 and 200 MA support, multiple points in the market, what would we consider it for? Like a bear market or flat market?
Could you repeat?
Like if we're touching, imagine if Nifty is touching 100 MA and 200, like Nifty is touching 200 MA support every second or third week. What would be considered that for? The market?
Yeah, as I said, whenever in doubt, go back one time frame. So let's say we are in daily time frame. So Nifty, for example, touched over here right now, which became a support incidentally. Oh, here. So all of these places Nifty touched, and back then it was for a few months at least. It was in a constant fluctuation around its 200-day moving average right here.
Yeah, it's like if you go to the latest one, when we touch 16,500, we approximately touch the 200 MA support, right?
Yeah.
So,
It's
like, what would we consider this as a bounce back or a back and wait?
as a long-term investor, you're just looking for more accumulation in case it's stays like above the moving average. Basically, if it's bullish, you want to just accumulate it.
Okay.
So
And
let's say,
and a smaller question, I don't know if I should ask this or not. Like,
mhm.
if we're breaking 550 MA and 100 MA, going to test 200 MA, is that considered a type of bear market or is that a downtrend system? considering it a downtrend, but would that be a market fell from 18,600 to 70?
Bear market is only lower highs and lower lows. So this is one of the more important supports and resistance earlier. It was earlier resistance and became support after a second wave. So let's say it takes out this one and makes a posts a new low and a lower higher than this one. So that's how we'll see if it's a bear market or no. Again,
Okay,
if there's any doubt, just go back to 1 week or 1 month, and you'll see it's still in bull market. For 1 week, you want to go below 15,378.
I think it's at 14,300 something. Like last time I went, it's at 14,300.
Yeah, yeah, you want to go below that for weekly.
Okay, on the weekly basis, we'll have to go below 14,300, and on the daily, like 16,500. We'll consider that as the 200 MA something.
Yeah, and remember, we are one of the more luckier countries that have never seen a proper bear market of 12 years or so, and our stocks have actually gone up always. Like Nifty actually has gone up always. Not all countries are as lucky. Most countries are not actually as lucky. Like Japan would be probably a more extreme example, but they have been in bear market for some 20 years, 20 25 years. They have just recently got out of downtrend.
Yeah, yeah, yeah. Hello. Thanks a lot, man. Thanks a lot.
Yeah, yeah. Should we wrap up, or do we have more questions?
Uh, yeah, actually, I had one. So,
Yeah,
am I audible?
yeah.
Yeah. So, when you say we have not been in a bear market in 12 years, isn't that concerning?
It kind of is because we actually never know what the next bear market is actually going to look like. The market's always going to stay ahead of us. And this is the first generation where there's algos and all kinds of high frequency trading and whatnot going on in the market. So even that plays a role in those forces that I talked about, the negative feedback systems and positive feedback systems. And nowadays, even algo have a lot of arbitration stuff. So they are one of the ones that help in negative feedback systems, basically bringing Nifty back to the moving average or taking it away from moving average. So yeah. So the next bear market is still, for most purposes, a mystery, and it's good that it stays that way.
Thank you.
Yeah, yeah. Thank you actually. So yeah, before we wrap up, I just want to let you know that this one is based on my second session. So we'll have at least a slight more discussion on Ned Davis's chapter. For now, I've just used the chapter to get the slide over here. But again, if you are more interested into technical analysis as a whole in a more organized fashion, you have to go through this book. It's slightly large, but it covers everything from confirmation to market breadth to even relative strength. Right? Can we wrap up?
Yes, sir. Thank you.
Yeah.
Yes, thank you.
Thank you.
Thank you so much for your time. Thank you.
Yeah, I have no problem. It was fun.